Jonathan Fenby is also China Director at Trusted Resources. He's in the studio with me now. Jonathan, thanks very much. I suppose we talk about slow growth in China. It's important to remember that we're still talking about growth that is above 9%. But nevertheless, you know, when you put it into context, slowest pace of expansion in 2 years. So what does this tell us about the challenges facing Premier Wen Jiabao?
Well, the irony in this is markets, of course, get spooked when you get a figure like this. 9.1% was actually the figure that we've been forecasting at Trusted Sources for some time, going down to 8%, 8.5% by this time next year. And that is absolutely on track for China. If you cast your mind back, a year, 18 months ago, all the headlines and all the market talk was about China overheating, because you had 10.5% growth. This is unsustainable. China's got to do something about it. And China is doing something about it, and it is bringing growth down in an ordered fashion.
Yeah, so in other words, you're saying that raising interest rates, they've raised it some 5 times over the past year, their efforts to curb lending, impose limits on home purchases and so forth, you're saying actually these measures are all working, so it's a good sign.
They're all having an effect, and of course we've had over the last 10 days a lot of stories from the big manufacturing hub in eastern China, Wenzhou, talking of small, medium-sized enterprises going bust. But you've got to, again, put all this into perspective. That's the effect of tightening, but only about 20 companies out of more than 200,000 in this area have actually gone bust. So you are having the effect of this in China, but it's, frankly, it's getting overblown by markets and the media.
So it's been overblown. What are the biggest risks to China's growth, though, Jonathan?
There is the risk of inflation, which was mentioned in your report, which is certainly not it's coming down, but it's not come down as much as it should. And you've got structural inflation pressure from food in China, which is going to go on until they get to grips with agriculture. The main threat at the moment is external, that the US and the EU fall off the cliff and exports really do decline. Although, interestingly, in the last quarter, the trade surplus was actually up.
Yes, so what would then another recession in Europe, because some say that we're already there, what would that mean for China?
It would shave Chinese growth, certainly. The contribution of exports to Chinese growth has been diminishing steadily, and the contribution within those exports that comes from non-European, non-US areas, such as Asia, above all, and Latin America to an extent, is growing. So China is cushioned. Also, exporters have prepared themselves. A lot of the very low-rent exporters who went out of business in 2008 are no longer in the game. You've got more bigger companies. But that said, an external downturn will undoubtedly hit China.
At this point in time, but presumably plans are put in place for China to increase trade and so forth with other regional countries. So, if anything, would deteriorating growth prospects in the developed world actually accelerate this process of decoupling?
It will to an extent, but still, you know, a lot of exports go. The EU is China's biggest trading partner. The US is enormously important, of course. So that is still in the system. The leadership is working to boost domestic demand, so there's less reliance on exports. But that's a 4-year process.
I know that you are very involved with the country and you spend a great deal of time visiting China and speaking to people there, and do you get any sense that perhaps a situation in Europe might present an investment opportunity for China, whether it's in terms of buying cheap Greek assets or buying sovereign bonds, or do you sense that this is a region they just want to stay away from?
I think assets, certainly. I don't think bonds. You know, China will make smiley noises about propping up the euro, but they're not going to get involved. They got caught in the dollar trap. They're not going to get caught in a euro trap now with a lot of euro bonds, which they're stuck with. On the other hand, they are very interested in investing in Europe, particularly in high-tech firms, and I think you'll see a lot of a push for that in the next year or so.
All right. And I'm just wondering, you mentioned slowing export growth being a risk to the outlook for China, and I'm just wondering about property prices as well. We heard our reporter Margaret Connolly in Shanghai mention this, she touched on this, and the central bank data shows that new property loans fell 43%. This was in the first half of this year. So are we seeing a cooling of the property market?
Yes, undoubtedly. Transaction volumes have fallen, particularly in the biggest cities, although they're still quite healthy in the smaller inland cities. Picking up on your report, the interesting thing, the question is, when does a cooling down of an overheated property market turn into a slump? And do you think that the process of cooling down will lead to a slump or not? Personally, I don't, but of course the bears are out there and think that it will.
All right, thanks very much indeed. Jonathan Fenby, China Director of Trusted Resources. Good to talk to you.